Well, Thomas Lee is the chief equity strategist over at JPMorgan Chase. He just cut his year-end forecast for the S&P 500, and yet his target 1350 is still up about 13% from here. Hey, great to have you on, Thomas Lee. Thanks for joining us.
Thanks for having me.
All right, so I got to ask you, and today's 2.5% move gets you a lot closer, but why are you so bullish?
Well, you have to remember when macro conditions are cloudy, investors are gloomy, it doesn't mean investors need to actually be betting against the market, right? I mean, I think one of the things you have to remember is, the market is positioning itself for basically either flat sort of outlook or really a downside outlook. And so, I mean, one reason we should be bullish is, things as bad as they look now are likely to get better. And I really think a lot of this is really going to be a corporate profit story anyways.
All right, a corporate profit story as opposed to a growing economy story?
Well, it's both. I mean, I think that, you have to remember, I mean, when you're buying an equity, you're really buying the residual of, what's left for you as a shareholder after paying off creditors. And if you look at what's happening today, I mean, corporate, business outlook's actually pretty solid, right? Sales growth is still sort of low double digits. Their companies' access to funding is incredibly low. In fact, I just looked at our 2012 credit analyst outlooks, and they're mostly constructive on various parts of the capital structure, and with that sort of being the backdrop, you can't really then turn around and say, well, equities are short because corporate credit's attractive.
Hey, Tom, you talk about corporate profitability, but there's also corporate cash. That's one of the reasons you actually like equities at the moment. But I want you to talk about your shopping list in that context. You like financials, you like technology, you like consumer discretionary. Are these sectors where there's a lot of cash on the balance sheets? Well,
I mean, yes and no. I mean, I think that what we think about in terms of between now and year end is the idea that, we think investors are going to start to think, well, 2012 the outlook might be slightly better because you've got pretty decent visibility on business outlook. The political situation in the U.S. I think really changes. You've got incredibly low valuations, and then companies are obviously big buyers of their stock. And when you start to think about a rally that takes place like that, I mean, the sectors you want to own are those that have gotten beat up, which would be, your cyclicals, but some decent sectors, within that are discretionary tech. And then, of course, we like financials because they're kind of a beneficiary of sort of all conditions improving, plus housing in the U.S.
Hey, Thomas, you make the point that there's a lot of cash out there being put to good use. But one of your own charts, and I want to show our viewers because I think it's pretty telling, is that the actual payout of cash going into either buybacks or dividends is right now about 41%. That is half of where it was just several years ago. So why is it that more money isn't going into buybacks and dividends?
Yeah, I mean, I'm glad you put that chart up because it's pretty telling. I mean, we have companies today at record profits, 6% above where they were in 07. And total cash return this year, which is buyback and dividends, is going to run around $880 billion. Which is about 30% below where it should be proportionately, and because cash is 11% of assets right now and profits are still growing, I think it's pointing to the idea that companies are going to dramatically increase sort of cash return over the next few quarters. I mean, I think that means you're going to see a big ramp up in buybacks next year and a substantial increase in dividends.
Are we going to see any kind of ramping up in hiring?
I think big business has been doing their part in the hiring. A couple weeks ago we pointed out that, if you look at what increased in terms of hiring this year, I think about 80% of the incremental jobs created this past year versus 2010 are related to U.S. housing activity. So, I mean, I think as U.S. housing starts to improve, that's going to actually improve the labor outlook.
Tom, what do you view as the biggest risk to your forecast now, the 1325? What gets in the way of us hitting that level by year end?
Yeah. Well, I mean, I think it's still in everyone's minds, the greatest fear is a systemic crisis. The tail event in everyone's mind is a banking crisis, a global banking crisis that comes out of Europe. And so the thing that's keeping me up at night is really a situation where U.S. banks really begin to face funding difficulties, and therefore that's going to choke off a U.S. recovery. But that hasn't happened yet. I mean, it's not really even any evidence of that yet.
Now, does that start in Europe, though, Tom? Are we starting to see evidence of that in Europe from your perspective?
I'd say without question, Europe as a region actually is facing a lot of headwinds, right? I think the PMIs are showing a contraction. Their banks are deleveraging. There are funding stresses both at the country level and at the company level, but that's really not a contagious crisis yet. It's really a European crisis right now.
And are you worried at all about GDP in Europe being really kind of flat, meaning they're not growing?
If we, not to be glib, but if you basically said Europe isn't going to grow, that might describe Europe for most of the past decade.
Might describe the U.S. too, right?
Well, actually, that's not true. The U.S. has grown over the past decade.
The stock market hasn't grown.
But the U.S. GDP is already above where it was in 07. I'd say that if you look at the past decade, the real engines for growth have been China, emerging markets, and also the U.S. Europe has not really been a contributor to global growth.
And that's not an issue?
Well, again, if it hasn't been, if you look at the past decade and you didn't have much growth coming out of Europe, and then we're talking about a situation where Europe's not growing, I'm not sure how that's really changing the picture for U.S. equities.
Tom, let's talk about the high level of correlation that we're seeing in markets and the high level of volatility. Does it make it difficult when you're putting a pencil, a fine point, to a forecast? How much do you factor that in?
Yeah, it's added a lot of difficulty, actually. You have to remember, it was only 2 weeks ago that we were basically at 1,300. The market lost 100 points in about 8 trading sessions. As we start thinking about, well, if you're here at 1,200, how do you get to 1,350? You have to remember, 1,300 is something we were at 2 weeks ago. There's a lot of volatility.
All right, you got to be a behavioral finance specialist, it seems, these days. All right, thanks so much, Tom. We got to leave it there. Pleasure to have you on Street Smart. Tom Lee, Chief Equity Strategist of JPMorgan Chase.